Hey everyone, and welcome to another episode of the Witty Wallet. I am your host, Kristoffer Fu, and today I'm going to talk to you guys about an often overlooked but very crucial topic that affects thousands of individuals every single year: the widow's tax penalty. This penalty can have a significant impact on the financial well being of the surviving spouse. And it's something that I feel honestly needs more attention and a lot more discussion. So let's dive right. So, as most of you guys may know, I work with a lot of individual widows. Mostly are women, but I do have some male widows. And this is something that I talk to them a lot about. And I also, talk to a lot of my married clients as well too, because this is all part of planning. So, what is this widow's tax penalty I'm talking about? Well, to put it simply, the widow's tax penalty occurs when a surviving spouse ends up paying more taxes on less income after the death of their spouse. I mean, think about that. You get less income, but you're paying more taxes? How is that fair? You might be wondering, how can this even be? Well, this happens when a widow or widower starts filing as a single filer the year after their spouse's death. This shift in tax status can lead to some significant financial consequences, including the loss of Social Security income. Now, what I mean by that is since Social Security benefits are calculated based on the couple's combined income, the surviving spouse will suddenly lose a significant portion of their income. The reason for this is because when your spouse dies, you cannot claim your deceased spouse's benefit in addition to your own retirement benefits. Social Security will only pay one, either your survivor benefit or your retirement benefits. Now, if you qualify for both survivor and retirement benefits, you will receive whichever amount is higher. What this means is that if you have already received retirement benefits, you can't apply for the survivor benefits if they are less than your retirement benefits. Now, I know that's a lot. So, to give you a simple example, let's just say that you were collecting $2,500 a month in Social Security benefits and your spouse was collecting $3,000 a month in benefits. Your spouse unfortunately passes away. What this means is that you'll be eligible to collect their $3,000 monthly benefit, which is the higher of the two, but you will no longer receive your $2,500 benefit. Now, of course, that's a simple example, and there are various nuances to this situation. And if you find yourself in this situation or you have questions about it, it'd be best to contact Social Security and also speak with your financial advisor. Now, additionally, it may, depending on your situation, may work in your favor to postpone applying for retirement benefits and give those benefits the potential for growth while you receive survivor benefits. Ultimately, again, every case is different. So, again, you have to look at your own individual situation and make the decision that works best for your favor. Now, when I tell people this, next thing, I always get the what? Why is that? I didn't know that. Well, did you guys know that up to 85% of your Social Security benefits can become taxable when you have a certain level of income? Now, in this case of a surviving spouse, up to 85% of their Social Security benefits can become taxable just when their provisional income is above 34,000. That's not a lot. So again, if you're above 34,000, potentially up to 85% of your Social Security benefits can be taxed. And this can contribute to this widow's tax penalty. A change in income tax bracket as the surviving spouse transitions to single filing status, the remaining income can quickly move into the higher bracket. This is primarily because a married filing joint tax status is typically more favorable and offers higher deductions and lower tax rates than a single filing status. So, to give you an example of this, let's just say you and your spouse, you're retired and you are collecting a total of, let's just say, $85,000 in total retirement income. And it could be a mix of Social Security, pension, rental income. Let's just say, again, in total, it's about $85,000 a year. And again, you guys are both receiving your Social Security benefits. And unfortunately, your spouse passes away. And again, you don't get their continued benefit. You're going to lose either yours or their benefit. So let's just say in this example, your income, what once was 85,000, now drops down to 70,000. Well, when you were filing jointly as a married couple, that $85,000 income puts you in the 12% marginal tax bracket. Now, in this situation where you lose your spouse and your income drops down to 70,000, again, you're now filing as a single person. That difference of filing single, what that does is it bumps you into the 22% marginal tax bracket. So again, not only are you making less in income, but now you're paying an additional 10% premium in income taxes. You're going from a 12% marginal bracket to a 22% marginal bracket. So, again, that's a huge, significant jump. And again, this is something that everyone should be aware of when it comes to future financial planning and planning for retirement and planning for these types of situations. Now, this widow's tax penalty can also add a Medicare premium surtax because with the change in marital status, there is also a change in the Medicare premium surtax. Give an example, a single taxpayer with the same income as a married couple will actually pay twice the Medicare surtax as the couple. So upon losing a spouse, the survivor not only has to pay more in income taxes, but potentially also has to pay higher in Medicare premiums. This can make a substantial impact when it comes to, again, the overall longevity of retirement income and your assets. So, this is where, again, careful planning needs to be done if you want to ensure that you're going to be okay for the long run. So, again, as a disclosure, any type of advice that I recommend is not meant to be for you directly. This is educational advice. So, if you want to explore these things that I'm about to talk about, definitely want to, again, meet with your advisor and figure out what situation, if any, might be the best for you. So, what are some possible strategies that you can potentially use to minimize the impact of the widow's tax penalty? Now, of course, there are a few strategies that individuals can employ to reduce the impact of the widow's tax penalty, and some of these include careful tax planning. Now, with proper tax planning and professional guidance, you can better understand your financial situation and make much more informed decisions regarding the upcoming tax years. Smart retirement account withdrawals. By strategically withdrawing from the retirement accounts like 401ks and IRAs, you can manage your income levels and avoid jumping into higher tax brackets. Maximizing deductions. By consciously maximizing deductions, you can keep your taxable income as low as possible, thereby reducing the tax burden. Now, be prepared, married couples, because again, you must be aware of this widow tax penalty and take precautions to shield yourself from its effects, addressing this issue early on and financial distress. Now, again, thank you guys for joining us today on the Witty Wallet episode about the widow's tax penalty. I hope you found this information helpful and also eye-opening. To learn more about this issue and other personal financial topics, visit our website, mavenbridgecapital.com, and shoot us an email. You can also shoot us an email directly to hello@mavenbridgecapital.com. Also, follow us on all social media channels, LinkedIn, Facebook, Instagram, with the handle @MavenBridgeCapital for more information. One last thing. If you know someone, a family member, a relative, a friend, a colleague who's recently lost a spouse, and you think that this information can be helpful for them, please feel free to pass it on. I'm sure they'll appreciate it. And it doesn't have to be anyone that just lost a spouse either. If you feel that there's just someone in your life that needs to hear this, please pass it along. Again, my goal is to create awareness. And again, as I mentioned, we can't predict the future. But the best way we can do in trying to predict the future is by making changes and having a plan. Right? We can create it by being prepared, by being aware and making the right actions so that we can live a lot more confidently with less stress and also more purposefully. Thanks again for listening. Take care. Till next time. Bye.
Securities offered through Kestra Investment Services, LLC, member FINRA, SIPC. Investment advisory services offered through Kestra Private Wealth Services, LLC. An affiliate of Kestra is Mavin Bridge Capital, and Kestra Investment Services are not affiliated. Kestra is in Kestras do not provide tax or legal advice. The opinions expressed in this commentary are those of the author and may not necessarily reflect those held by Kestra Investment Services, LLC or Kestra Advisory Services, LLC. This is for general information only and is not intended to provide specific investment advice or recommendations for any individual. It is suggested that you consult your financial professional, attorney, or tax advisor with regard to your individual situation. Comments concerning the past performance are not intended to be forward-looking and should not be viewed as an indication of future results.